Good evening. It's good to have you all here. Uh, this is Anshul here. I'll be your host this evening. Welcome to LV Insights. Basically, what we are trying to do with LV Insights is we are trying to bring a series of interactive online AMA sessions, the Ask Me Anything sessions, to help all of you understand about the trends of the ecosystem, where we basically deep dive into conversations around topics like, say, metaverse, to gaming, to fintech, impact investing, health tech, SaaS, and whatnot, right? So we look forward to all of you joining us, learning, and making more informed decisions around investing. Today, we have our third session on SaaS investing with Mr. Bhavish Sood and Mr. Sameer Kanwar, where they will deep dive into SaaS investing sector in India, right? So I'll quickly introduce all of you to our speakers today. Talking about Bhavish, so Bhavish has almost 2 decades of experience spanning across research, consulting, and venture capital. He started with Virtusa and Gartner, where he formed his roots in understanding businesses in depth. He then moved into fund management with 3737 North Capital. He currently sits on like half a dozen boards of investee companies and heads venture investing at Modulor Capital. So welcome, Bhavish. We are looking forward to having you for the session.
Thank you, Anshul.
Talking about Sameer, so Sameer, who is the CEO of Basil Technology Partners, has over 25 years of experience into the IT industry, including over 14 years with Basil investing in niche and emerging technology companies. Based on his deep operational experience, Sameer has worked closely with Basil portfolio companies to drive aggressive growth through a combination of, say, organic and inorganic strategies and a real focus on value creation for all stakeholders with a predefined exit horizon, which has resulted in a track record of delivering more than 25% IRR return to investors across 3 funds. That is crazy. So welcome, Sameer. We are super excited to have you here for the session and learn a lot from you.
Thank you, Anshul. Appreciate it.
Awesome. I'll just quickly give you an overview of how the next 60 minutes are going to look like. So we have a very brief presentation for all of you directed by Bhavish and Sameer, where they will help you understand more about SaaS investing in general. Then we have a certain set of curated questions that have been presented to us by the audience themselves. And then we'll open up the stage for audience Q&A as well. Right. So I'll not take much of your time. I will let Sameer and Bhavish to please take the stage forward.
Thank you, Anshul. So in the next half an hour, I'm going to run through some slides. Depending on the audience, there could be, a few investors in the audience, could be software folks trying to build software companies. So I have a good mix of content. I think it's interesting to know there are some facts which I want to know. So when we talk about funding, we all talk about exit scenarios, right? And exit scenarios typically are M&A, acqui-hire, or an IPO. And what we don't realize is that if you got a seed stage check, you actually need 100 million to take a company typically to IPO. 100 million, okay? So keep that in mind when you're building it. And, quite frankly, even exits, are not very easy. You need 25 million if you're focused on large software companies to buy you out. And you need 50 million if you're focused on SMB customers. So, keep that in mind. If you look at average promoter holding, pre-IPO, in a software company is about 7%. If you look at about 70, 80 software companies which have gone public, typically they own about 7%. So yes, we've all been taught that protect your dilution, but dilution is the reality of the game. That's what eventually, and when you look at a venture fund, a large venture fund at an IPO will typically own anywhere between 18 to 21, 22%, right? So, how VCs design their portfolio, double down on some of the companies which, are doing well. So keep that in mind. The other thing which, I interestingly get is, even from some of my, peers, in the investing industry, they say, hey, this company is doing some services. They have a lot of non-recurring revenue. But, interestingly, what you'll notice that among the publicly listed software companies on NASDAQ and New York Stock Exchange, this is very specific to the US, non-subscription is on the median on the on the non-subscription is about 23%. That's pretty high. And I'm going to talk about a little bit later on. The other thing which we saw, which came in the last 3 or 4 years, we saw a lot of models which were focused on distribution first. These are not product-led growth, but distribution first, focused on downloads, trying to build a community. And then, they'll say, we'll try to monetize it. They're actually going out of work. And the classic example of this is Dukaan, which last month, kind of pivoted to a subscription sort of a software. We saw their CTO's tweet go viral when he picked on the architecture of Shopify and why it's not designed for a mobile first world, right? So you'll continue to see that, there are iterations of business models happen in the market, right? But before we start, just want to do some level heading on some facts as we, the other thing which you notice, compared to S&P 500, the horizontal, this is analysis from Black Peak Capital. If you notice, the horizontal SaaS and vertical SaaS companies have fallen much higher than S&P 500 and including the S&P 500 IT as an index, right? So this is, year to date, if you look at it, 16% drop in horizontal SaaS companies, vertical SaaS companies about almost 12.5%, compared to 500, almost 5.5 on S&P 500, right? So what that really means is that there is a severe correction of valuations on the the IT side. So I'll give you an example. When the Feds increased their rates by 75 basis points, the venture capital refinitive index fell almost 52%. That is how sensitive it is to inflation, as an example, and spending. Now, I briefly touched upon what I call non-recurring revenue. This is a favorite theme of mine because you cannot let go of services and non-recurring revenue in an IT company, and especially in a product company. Why? But 2-3 reasons. One, you tend to get free money, right? If you do services, as long as the services are attached to that product and you're helping it implement in a in an end user client environment, and you take a fee, that is free money. There's nothing wrong with it. In fact, it will, over a period of time, it will improve the stickiness of the product and the client, and it'll also help you understand the client requirements. A lot of those services components can eventually be part of the product roadmap. So it's important, especially in the earlier stages, that some sort of services is done, and think of doing services around the product as customer success. That's how you need to look at it. The second thing I want to kind of emphasize that subscription is not the only source of revenue. So if you look at Shopify, which is now has seen a very significant drop in its valuation because it had a lot of pumping up of valuation during the COVID times, because the market thought that everything was kind of moving online, and as people have started coming back to the stores, or they're moving towards an omni-channel kind of a model, Shopify's stock has dropped. But there's also one other reason: it's actually no longer a subscription company. So interestingly enough, its merchant solutions are 71% of its annual revenue. So only 29% of its revenue now is subscription. Another example, Toast, which is in the restaurant POS space. They have 57,000 customers and 57 billion of payment volume is getting processed through their POS systems. So interestingly, what's happening is that subscription is not the only source of revenue, and this is fine. I think over a period of time, there are two scenarios which will happen. One, these companies, the payment processors will start acquiring software companies because they're becoming very, very big. And they will realize that, in order for them to protect their payments business, they actually need these, software companies to be like a protectorate. So that's what is going to happen. Another Indian example, it's not exactly kosher on an Indian webinar so Glam Plus, which LV ran, as a syndicate just last week. I don't want to divulge the exact number, but they have a marketplace where spas and salons can buy and procure goods, right? So they have a B2B marketplace. So what does that do? That allows much more attachment to their software, right? So that's what people are doing. So what are some of these models here? Goods marketplace, where you take a cut of the GMV, embedded finance, which could be payment processing, even commercial open source, which is basically, if you look at commercial source, what open source does, it moves market or money from licensing to support. So you can use a version in the open community, and then you do you pay for support over a period of time, right? So we are seeing a plethora of business models play out in the the software space, which is interesting to see. Switching tracks, just want to give you a little bit of headline into what are some of the software areas which we're seeing. Obviously Web3 crypto continues to be very strong. One of the interesting trends which we've been observing in this space is micro SaaS. A lot of small companies building very niche applications. Flowworks, one of my favorite companies in the BPM space, they built an entire BPM suite on WhatsApp. EasyBee has built an entire CRM stack on WhatsApp. LimeChat has built a conversational AI, conversational commerce platform on WhatsApp again. And there is Haptic, which has built chatbots, a product called Interact. And this Paperplane, sorry, which has built and actually a EMR plus a patient management system inside a WhatsApp system, because doctors are not very comfortable using browser-based software because those are pretty old, right? So we're seeing a lot of this micro SaaS comes in. US has specialized M&A scenarios for micro SaaS, companies with like 10, 15, $20,000 getting acquired. So those for reasonable multiples, right? Metaverse Web3, no brainer there. We have companies like Fabric and Zeev, who have raised a lot of money. These are all Indian companies, focused on AR, VR, digital twins, and crypto. Neum Crypto is actually building like an AWS of crypto. So this is a very interesting field on its own. Applied AI, basically applying AI to some of these newer problems which were not being solvable. So synthetic media, conversational AI, invalid traffic, trying to detect bot traffic, which is a big brain on the the media side, on the traffic consumption side. Then synthetic media, you have companies like Orbo in the synthetic media side. You have Group, which is doing interesting things. Dubverse in the NVIDIA and the speech analytics thing on the machine-based translation. So imagine not needing people to transcribe a lot of the data on the speech side, right? And then you have a company like Rezo, which is in the conversational AI space. As another interesting area which is leading to a lot of investments is what I call commerce tools. Commerce tools basically, as e-commerce is rising, very similar to how in the gold rush people made a lot of money selling picks and shovels. Commerce tools and enablement, is actually becoming pretty big, and you're finding many vendors there. Vixo just got majority acquired by Shiprocket. They do marketing automation just for DTC and retail brands. Freestand does more data-driven, data-driven sampling. So you don't need to go and hire a small podium inside a retail store. You can do it online through a selection of courier services. You have Seller Genie and Seller App, which are more doing Amazon-based PPC. Then Better Commerce, which is building Better Commerce is building headless commerce infrastructure. So then you have Better Commerce and Rodeo, which is doing headless commerce. You have companies like Sales Assist, Unscript, DeckPeg, all in the live commerce space, doing very interesting things, but very unique way of looking at the whole live commerce. Text Mercato, which is doing cataloging and product information management, right? So these are the kind of companies which you are interesting to see based on some of the themes which you are tracking. Vertical SaaS, again, since Zenoti has become a unicorn and it's on like a $50-60 million run rate, people suddenly realize that there are interesting opportunities there. We recently spoke to TurnApp, which is doing laundry management, ERP. You have Glamplus in the salon spa space. You have ShoppingPal, which is building very cool. It's less SaaS, more PaaS. iPaaS, which is integration PaaS, which is building integrations for a lot of the POS systems based out of Pune. You have LimeTree in Delhi, which is building restaurant management, like an Indian version of Flow. So very interesting to see different types of companies come out of India in all the themes which are interesting globally, which, if you talk to people at McKinsey and Gartner, they'll tell you these are the interesting areas, right? So in process automation, again, Industry 4.0, process mining, BPM, all the reasons for why there are interesting companies there, DesignX, Ekanta, Auditly, so the interesting thing I think to note from this is that whatever theme you might think of in the Indian market, you will find multiple vendors trying to attack that space. And I think that's very interesting from an ecosystem perspective, because what it shows is the maturity and the creativity of the founders. And it also shows the availability of risk capital for all of these kind of companies. So interesting to note these things. Now, one of the, shifting tracks a little bit, one of the things which I regularly as a seed investor, kind of get asked is, well, how do we decide what is the level of dilution we need to do? And how do we capitalize an early stage company? Now, there are, valuation-based financial economic models like DCF as an example, Barco method. There are like 7 or 8 methods, but in reality, the right way to do something like this is very simple. You calculate the number of the amount of money you need for 18 to 20 months, and you basically divide that with a 20 to 22% kind of a dilution. Now, the another way of looking at it is some of the VCs say it's not based on the amount, but the amount of money you're raising. So, rule of thumb for a software company, $500,000 in seed is a bare minimum. I would say 500 to 750 is what you should be raising as a software company, unless you have some sort of a revenues. You can project and say that you have 100 or 200,000 revenue kind of coming in. Then you can potentially do about 500. But if, for example, you're building AI company and those AI resources are very hard to find or they're expensive to find, and you're competing with not only the unicorns but also with the global majors who have set up their own capability centers in India, then you need upwards of $1 million and $1.5 million. That is what you will need to capitalize. So that's the rule of thumb, which we advise software vendors. Now, another interesting thing is how do you decide what are the metrics to follow on seed versus growth stage, right? And software investing, obviously, it's different. Now, from a product perspective, in a pre-seed seed kind of a thing, so MVPs are not in vogue anymore, right? I mean, we continue to use that term as an MVP, but I think the reality of the market is that clients more than VCs expect the product to be SLC, which I call simple, lovable, and complete. So it should be able to demonstrate very well that whatever functionality and use case or the problem is there, you're able to solve that. That's one. And when you go into a growth stage, what they will look at, they will actually, in most Series A deals, when you're raising anywhere between $2 to $5 million or upwards of $5 million, they will hire technology firms to look at your architecture, the quality of your code, the kind of cyber traps you have, the logic, how strong the application is built from a scalability and extensibility perspective. So it's going to be very different. And on the TAM side, obviously, VCs will only invest typically in companies which have high TAM. And now, while high TAM is very vague, but I would say most VCs tend to look at $2 to $5 billion kind of markets, and your ability to take a large, maybe like upwards of 10 to 15% share, in the market. Sales, in the seed stage, what typically a VC firm will look for is a balance between product and early sales execution. I'm going to talk about this a little bit more when I stereotype some of the types of entrepreneurs we kind of meet. But when you suddenly go into a Series A or a growth stage kind of a raise, VC is expected to show a month-on-month growth of about 20 to 30% on an ARR. And for you to be able to raise a Series A, if you're a software company, you need ARR ideally at about $1.5 million. In select cases, VCs will also do companies will start looking at companies who have achieved about $1 million in ARR. Even the SaaS metrics from a financial, non-financial perspective, very different. In seed stage, founder market fit. Now, again, very loosely termed word, but let's say you were building something in, we talked about applied AI, but if you're trying to build something in the applied AI space, especially around, let's say speech and synthetic media, speech analytics, then a lot of those solutions and technologies are in the academic realm. So you would expect the founder to have maybe a PhD or have a research leaning towards those in those areas of investing. So building a product, right? So that is what I call a founder market fit. Customer success discipline, trying to get early stage customers. Yeah, I mean, some of them will say I have 5 or 6 customers. They tend to be our acquaintances, but how well are you, focused on customer success is very important. And obviously an acceptable churn limit, right? Especially if you're doing consumer SaaS, I expect the churn to be less than at about 15%. Very simple. Anything above 15%, your LTV to CAC ratios will go away from 3 to 1, and basically have issues on the lifetime value. Now, these metrics dramatically change when you go into Series A. The minimum expectation of growth is 3 to 5x, more on the 5x side, because you're actually taking and earning money for growth. So there is an expectation there. A reasonable burn limit. So an ideal burn limit is 1x or 2x of the amount of money you have raised, and a net retention rate which is positive, ideally above 100 to 120%. So the metrics will dramatically change. the team, the early stage, you would expect the founders to be able to build what I call a simple, lovable, complete product and scale early sales, among themselves without taking some help. But when you suddenly go into Series A, the funds will start looking at whether you have a VP of engineering for the product to scale, and obviously, whether you have you have brought in a revenue leader who's going to scale the sales function. And typically, the valuation ranges in pre-seed and seed, from what we are observing in the Indian market at the moment, is 1 to 3 million. And in Series A, we're typically seeing 8 to 10 million kind of valuation. Obviously, these are median values, and you can expect to see some aberrations of this criteria. So we talked about stereotyping the founders, but typically this is our analysis or our observations, you can say. Typically there are 3 types of founders which we have observed. Selu, pardon the spelling, it's by design, can sell anything to anyone, but has a weak view of product and domain. And then those are others who are obsessed with the product and think that the product alone can change the world. But in reality, what I've observed about good entrepreneurs is that the ones with strong domain, ability to build a product and can sell, these are the ones eventually kind of end up building large software businesses. You need a combination of these two. And the reason I say that you need a combination of two, very simple. If you don't have a good product, you can't scale your GTM. And I think there's a term, there is software as a service and there is SMAS, which is services masquerading as a product, or services masquerading as a software. So there are 2 types of products which are built in the Indian market. The SaaS products, which are built well scale, but not SMAS. So interesting to note that. I'm going to take a pause here and shift tracks. I know there are a lot of software entrepreneurs also who are there. I'm going to talk briefly, about modern software GTM. Now, when you look at how software GTM is kind of categorized, typically you'll see five flavors, right? We've seen product-led growth is very interesting. So Zoom gives you 40 minutes, Slack gives you, I think, access to ability to search 10,000 messages. But you'll see that they give away a lot more free than they actually convert. So Slack only has like maybe 3% conversion ratio, right? So 97% of their client base is still on the freemium tier, but yeah, it's top of the funnel, so it's easier to convert, right? And when do you typically use that? Where you have a self-service kind of a product. An enterprise product which requires integration and has security requirements, of integration, those typically they don't do well in a product-led growth. Then you have sales-led growth, which is your typical sales, right? Companies like Microsoft and all do it. You either go through a channel resellers, or you have your own sales team, which is selling large enterprise contracts. This is your traditional. This is how software has been sold all this while. The third one is getting very popular. You've seen a lot of companies in this space go IPO, MongoDB, Elastic. That had got acquired by IBM in the past. So basically, leveraging open source and then providing customer support, bugs, fixes, and more than that, indemnification, in case of a lawsuit. And then you typically use that, when you need instant feedback, you have a community, it's decentralized, you have a crowded space, those kind of things. MongoDB is a poster child of that market. They have a managed services business now called MongoDB Atlas, which is doing, probably is on a, in my assessment, a 500, 600 million kind of a run rate now. Very large business. Then there's waitlist. A lot of the hardware guys have also tried this, like OnePlus, but Superhuman, which is an email productivity tool, very expensive, like $30. But whoever uses it raves about it. They kind of create excitement through mismatching demand and supply, right? Create excitement on the scarcity side. And obviously there is a lot of community building which is happening. So HubSpot bought this media property called Hustle. I'm not going to get into the specific why they bought it, but the long short answer is basically the cost of customer acquisition is very expensive. And you have a product on the PLG side, but if you can build an army of people who actually believe in you and build a community, those kind of things, really help. So people are buying community-led media properties also, especially the software companies are all going to buy media companies to lower the CACs. So modern GTM, we talked about this. I can give you a flavor, but an interesting way of looking at this. There are two tactics which I want to kind of emphasize, which are building it. One is called building out in public. It's mostly useful, when you have to distinguish or create a new category. That's a good way. That's a good way to build out. The second interesting thing to do is very simply what I call, in a crowded marketplace where you actually have to showcase the value of your software, right? So it's about founders. They finalize a platform like, let's say, a LinkedIn or a Twitter, and they start sharing public stories, being authentic. They say some of the founders I've seen. Fabric's founder, Puneet, does a very good job. They even talk about, what are the challenges. Another favorite of mine in that space is Rahul Mathur, who runs an insurtech called Virat. So, he talks about his challenges. He talks about, they're also showing their vulnerability. He said, for example, I remember one post, he talked about customers, and he talked about 3 people who were not very successful in their environment, but went on to do very good jobs. So, just being very authentic and being very open to feedback. And there are multiple things. The playbook is very simple. You can share real quotes and screenshot of feedback from users. But yeah, you have to be open that there will be some backlash on some of the things you propose interesting product ideas, ask the community for feedback, So I'm going to leave these slides for you to, go through the playbook, not in the interest of time. But, there are people, Fast although has now shut down, but Mighty App, Lambda and Fast also to some extent, the founders of them built very strong communities, through building out in public, and that brought in a lot of their customers also. But again, they were all authentic. They admitted to the mistake. Austin said, enrollment in the iOS program for building web apps, they shut it down. So and Sohail, he built a Mighty App, the entire year he shared updates in public. And very interesting way, but again, not suitable for everyone. It also requires a very outward kind of a thinking, an extrovert kind of a personality. So not suitable for everyone, but very interesting to see. The other tactic which I want to briefly discuss is, how to leverage, social discovery. So if you look at pay-per-click, how it used to happen with software companies, they would go to the standard media property. So they'll go to Google searches and they would buy AdWords based on certain keywords. I did it very successfully when I was at Zycus doing product marketing. It had absolutely the highest ROI among all the marketing activities spent. But off late, what has happened is there are these websites like G2, Gartner Peer Reviews, Trustpilot, Product Hunt, AppSumo, where users are going and discovering software on their own. So they don't pick up the phone, but they go to these places and look for peer reviews and product reviews, right? So social discovery is becoming important. Again, the 3 or 4 top properties, G2, Gartner Peer Reviews, TrustRadius, Trustpilot, Product and AppSumo, they should all be on your radar. Many of them also have programmatic ad networks now. So you can actually do pay-per-click advertisements also, right? So they're like becoming the Amazon of software search, discovery, and buying. Very critical if you're trying to build out a software company to leverage these platforms, as part of it. So that was a small snippet on what I thought about GTM, for the software entrepreneurs on this call. But those now switching tracks back to, from the investor's point of view. So a lot of angel investors ask me, what are we looking for when we're trying to make a software investment? The ones who come from a software or IT services background are able to judge, but a lot of people don't understand whether this application will work, whether there's a demand for it in the market. So I'm going to talk about some of those kind of things. Now, the criteria which funds follow is very simple, but in seed stage, typically it's about the business, but it's not about the business, but always about the founder. So especially true in seed stage, Series A, I talked about the metrics which are important, right? Quality of the founding team to build a large business. Will they be able to hire talent? Will they be able to retain talent? What is the size of the opportunity? What is the business model? We talked about SaaS businesses. We talk about marketplace businesses. We talk about subscription businesses, right? Now, why is this problem? Why is Glam Plus done well compared to some of the others? Very, very simple. There were 4 or 5 companies in the same space managing the salon ERPs, building the salon ERPs, but they were not successful. So the ability to build a new business model and trying to remain afloat is very important. So those are the things which kind of need to look at. Has the ability to return the fund with a 20x return? No, doesn't happen always. Sometimes, and I'm going to talk about how it is, and then sectoral criteria. How are they going to build distribution? Are they going to build distribution using product-led growth? Are they going to be able to sign up partners who can distribute on their behalf? And how strong is the tech from a SaaS applicability perspective, right? So those are the kind of things which you typically look at. Again, very subjective. Then the other thing which we always talk about is the power law, right? So power law, very simple. The best example of that is you look at Pareto analysis. 20% of the investments will return 100% of your capital. Now, if you look at 500 startups data, they've actually done extensive fund return modeling on this, and so has AngelList. So 100 investments typically will lead to 2 unicorns and potentially 4 unicorns. But you have to keep in mind that if you invest like in 100 Pan Ki Dukans, you're not going to get a unicorn out of that. 2 of the Pan Dukans are not going to become unicorn. So you also need to have access to a pipe, which is better than among what others are getting. So what that means is only the top percentile of the funds will be able to get these kind of returns, right? And a great example of this power law curve is what you call Y Combinator. So the top 3 companies, which is Airbnb, Stripe, and I forget the third one, have brought in a humongous amount of, maybe about 75% percentile of the, they're in the 75th percentile of the returns, right? Just 3 investments. And they probably do maybe like 100 in a year, if not more, across the 2 cohorts. And I think I read a scary statistic somewhere, in a good way, but still scary, that just the return on the Airbnb IPO was enough to take care of funding for the next, I think 20 or 30 years of cohorts, right? Which is an obnoxious amount of return. And, one of the things which I increasingly see, founders fight with, they say, I'm only going to dilute 10%, but you have to understand the business model of the business. Accelerators are happy to take 5 to 7, 10%, but in seed stage and growth stages, funds will typically own about 15 to 20%. So I'll give you an example of that. Why do they do that? Because they obviously the power law is getting applied. So you need to own a substantial amount of shareholding in a company. So let's say out of 10 companies, 2 did really well, 4 shut down, and 4 were average returns, right? So the 2 have to have 15 to 20% of shareholding to be able to compensate for the losses in the next 8. And that's where the power law kind of gets applied. So a great example of that is Unity. So Sequoia owned across 5 stages of investment about 21% of the company. So they consistently doubled down and executed their pro rata as Unity went through multiple rounds till the time of the IPO. So very important to understand power laws. Now, interestingly, returns also take time. It takes time to build a business. So obviously, when it takes time to build a business, it takes time to return. So 1x to 3x typically takes 1 to 4 years. 5x to 20x typically takes 4 to 5 years, right? And 30x to 100x typically takes 8 years or more. Unicorns used to take about 10 to 15 years to mature, but are increasingly taking less time. But still, rule of thumb, if you look at some of the newly minted unicorns, let's take Freshworks, which is an Indian example. It took 10 years to IPO. So it's not uncommon, and also it's not uncommon to have a unicorn today at 20 million. It's but a lot of it is based on supply of money than actually business fundamentals, right? But it's possible to have a 20 million company, have a SaaS company at 20 million to have the unicorn status. With that, I'm going to hand the baton back to Anshul so that we can initiate the Q&A.
Thank you so much, Bhavish, for such a detailed explanation about SaaS investing. I am so sure that it helped all of us. I won't take much of the time, just as to mention all of you. We are starting with the Q&A part, where you can either put your questions in the chat box or the Q&A tab, or you can raise your hands as well, and we would allow you to ask your question. Right. So we'll start with the curated bunch that we already got from the audience. So Bhavish, I know that we have already spoken about this a little bit, but if you can just deep down a little bit into how to evaluate sustainability and economic modes of SaaS companies in the long term.
Yeah. So, I think there are two ways to look at the the modes of software companies, right? One is the strength of the technology they have. It should. So typically, when you do when somebody buys a software, you basically evaluate on three parameters. Is this helping you grow more revenue? Is it helping you reduce cost, or it's helping you improve service efficiency? So if your software is not focused on one of these three parameters, the chances of you having a success in the software world is going to be very limited. Okay, so that is one. So the second thing from an economic mode perspective is very simple, is based on pricing, right? So Freshworks, if you look at Freshworks as an example, which is the poster child of SaaS in India, they did two things. They focused on pricing as an advantage because of the location, right? So what Freshworks has done is what the large IT majors like TCS, Infosys, and Tech Mahindra have done on this IT services side. They've taken the labor arbitrage and monetized that. So the software companies are also doing that in the Indian context now. And Freshworks is a great example. Plus what they did was they married that cost advantage or cost arbitrage with very strong customer success. And very strong customer success was tracked through metrics. So it's a combination of these two things which kind of help them achieve the in 5 years, 5.5 years, they were at 100 million run rate, just powered by these two. It took them only a year and 2 months to reach their first 1.5 million.
Wow.
Thank you. Just to add, Anshul, to that aspect, what is also going to be very important from sustainability is the kind of a product which you build, which has a universal appeal, as opposed to a geo-specific. Because the moment you get constrained to a geography, the biggest challenge you'll come across is that you would get bottled in and the valuation uptick will not really happen. But if you use a specific geographic market to look towards improving the product, as well as look towards building on it for a global coverage, that is going to be a very critical aspect for the companies, especially in the SaaS world, to gain value share.
Understood. Thank you, Bhavish and Sameer. So again, I would suggest like this might be all of our questions. Like if you can help us understand what are some basic major challenges that are faced by the SaaS companies?
So I think the biggest challenge I would see is large enterprise customers not willing to buy from software companies. I think that is challenge number one. I see that with my portfolio. I have lived through that, during my consulting days at Gartner. And to be fair, a lot of these enterprises are not sure that once they make a bet on this software company, whether it's going to survive, whether the product is going to scale or not, does it have the enterprise chops? So let's take conversational AI, which we talked about as a theme. Now there are 3 or 4 large companies in the space. You have Skid, you have Yellow, you have Rezo, who are doing that. But let's say hypothetically you went to AT&T as a customer, and you said, AT&T said, can you integrate with my mainframe system, which is my billing system? Can you integrate with the dialers and loggers in my call center, right? Those are enterprise use cases. And in a lot of these companies might not even have that as part of their roadmap. They might even want some integration with their core system. Let's say, their core system is a portal, a core billing software by Oracle, which AT&T might be using. So these are the kind of challenges so I would say the ability of enterprises to buy from startups. Second, the understanding the enterprise grade requirements, which could be integrations, it could be security, those kind of challenges. And the third, I think are more internal. So the 2 top challenges in my assessment are talent. Very hard to find product talent, especially product management. CPOs, VP of products, very hard to find. But you'll see Prodzen, product folks, these kind of communities kind of coming in now. Then I think the GTM is kind of is a bit of an issue, because we, apart from Freshworks, we've not seen too many in Zoho to some extent, and now you have Zenoti coming in, you have Browser Stack, these kind of companies kind of coming in, but the playbook is not available. okay, on how to scale GTM for Indian software companies. And I think SaaS Boomi and SaaS Insider, the two communities, doing a phenomenal job in kind of opening that playbook, to the younger product companies.
I think to add to that, Anshul, some of the challenges we've seen globally, in terms of the scalability from an entrepreneur perspective, is also related to proper business planning. Because a lot of times what tends to happen is that the business plan is very, very focused or built not with the right expertise. So it's always a question of getting the right kind of business support from people who've been there, done that. So it's always very important for entrepreneurs to have the right set of advisors, or we call it more as fractional CXOs, to actually help in terms of expanding and punching above their weight category. The second aspect which comes across, especially when any SaaS company gets its first check at the early stage level or even a Series A level, is they think they're flush with cash and they stop looking at the working capital requirements to actually look towards marrying product development as well as a GTM focus. And very soon, companies which have only focused on product development or improving product features without keeping the market realities into play run out of cash very quickly. So I think those are the key challenges entrepreneurs need to look towards, and building the right kind of investor base who actually help them with the right advice of both organic and inorganic growth strategies. A lot of times entrepreneurs are trying to do everything on their own in an organic fashion. And what they need to understand and appreciate is that every market has a different characteristic. And sometimes, especially when you're at that early stage and you're trying to grow aggressively, it is better to get people who become more partners, even in terms of diluting from an ESOP or a share perspective by doing, like-minded, I would say, promoters as an acqui-hire, as opposed to trying to do everything alone.
Got it. Thank you so much, Bhavish and Sameer. I am so sure that this particular enlisting of stuff helped us understanding about it. I'll again mention it. If you all of you, if you have any questions, please feel free to put it up in the chat box, or you can raise your hands, and we'll allow you to ask your question as well. Right. Moving forward, let me ask you one of the most important questions that every investor might have. Can you let us know a little bit about the future trends into the space, as well as what are some key areas of investments?
Yeah, so I briefly discussed that. Just give me a second. So, these are some of the themes which, we talked about, but, when you look at where the only thing this is kind of missing here is these are more application SaaS. So, I would add DevOps, MLOps, and the API economy. Postman is a great example of that, which is like pretty much the gateway to the API economy in the world now. Actually, that reflects the 100x valuation they've had from a revenues point of view. But on the application side, micro-SaaS, we talk about this: Metaverse, Applied AI, commerce tools, and process automation. And I would add, like I told you, I would also add low-code, no-code tools to this. So these are the the areas where most of the kind of investments are happening. And interesting to see, which I find very interesting, that you take a space or a subsegment in the Indian context, and you will find that there are multiple vendors playing in that space.
We have one more question into the chat box. So cool. Sharat, if you can ask your question.
Hi, Bhavish. Thank you so much for the presentation. So let's consider a use case like Glam Plus, right? Or something like Khatabook, where the user is a SME or a small business, right? And it's very fragmented. You're basically building it for lakhs of users, right? And if this particular, let's say, Khatabook, which started as a core billing software, right? And if they now want to convert into marketplace, let's consider these SMEs are niche, right? Like Glam Plus Khatabook is what I'm talking about. So if this Khatabook wants to pivot from billing to a marketplace, wherein now I want to build billing app for these users first, for these SMEs, but I want to leverage on the users later on to build a marketplace. How do you convert them as your partners and basically, plunge to that next pivot?
Yeah. So typically the playbook you would follow, there will be a Khata book plus kind of features which will get launched with some sort of feature sets, more differentiated feature sets. And then what you would do is you will start charging a percentage of GMV for facilitating the transactions there. In order to achieve that, you have to ensure there is no deplatforming, that people are not getting introduced, seeing the goods and then doing transaction offline. So you'll have to ensure that the entire process from start to finish of buying and selling a good, including payments, reconciliation, all of that, happens, online on their Khata book platform. That's typically how you would do it. But like I said at the start of the presentation, the distribution first models, I think, are under severe threat. So these guys will have to figure out very strong capabilities in embedded finance. So they'll start doing buy now, pay later, or start charging as a percentage of the transaction, just like the POS guys like Toast and all do. So Dukaan, as you know, is already kind of trying to become like a Shopify for mobile, becoming more like a headless mobile solution. So that is how typically you would build a business model.
And also, if it is building from 0 to 1, right? Let's say if something of this model wanted to build is going from 0, they build this MVP, which is good enough. They want to go to this first 100 SME business users, right? Obviously, we would have to give them for free to see the metrics, to see the retention.
Yeah.
And at what time do you feel it is comfortable to start charging them?
So I think, again, it depends on the software category where you are trying to do. The larger, the people like Khata book and Dukaan would continue to build a very substantial distribution mode first. But if you are a consumer SaaS, you also have to keep in mind that there is enough economic realization. So we come across SaaS, micro SaaS companies, which are 1,000 rupees a month per company. Those kind of businesses are never going to be sustainable because your LTV to CAC ratios are never going to be adequate. You'll be spending more to acquire a customer, but you will not have lifetime revenue. So in those cases, lifetime revenue will be upwards of 3 to 4 years with no realization. And then, you'll have to, you'll basically have to set up an enterprise sales team, and there will be cost to it. And then there's no discovery or self-service. So those kind of things will never, be economically viable unless you start doing embedded finance or those kind of things. So let's take Shopify as an example. They've launched, so merchants is such a big part of their revenue now, like 71%. Day before yesterday, they've launched 100 plus applications just for the merchants side of the business. So, you can't build, the point I'm trying to emphasize, you can't build platform from day one.
Understood.
Companies become platform over a period of time based on number of users they have.
Right. Thank you so much, Bhavish.
Thanks, Sharad. I hope this answers your question as well. We have one more question from the audience, which states as, so Bhavish, you talked about software service companies masquerading as product companies. Could you talk a bit more about this? And as an investor, what are the right questions to ask to differentiate them?
So I think there are technical questions about the quality of the code, the way you compile the code, the way you build out the code, how you deploy it from a DevOps point of view, whether it has a multi-tenant architecture or not. So those kind of things very clearly. There are certain set of engineering guidelines for SaaS companies which you can kind of follow, freely available on the web. I can also send you some of those links, how to look at it, about code extensions, those kind of things. The second thing I would say is one of the things which I've commonly seen is what I call people over engineering. So there is under engineering and there is over engineering. So I've seen companies start out to build a product and they've certainly built microservices based architectures from the first release of the product, right? Thinking that we're going to scale. So that's an overkill, both from a performance perspective and from an engineering perspective. So, I have seen how the Silicon Valley based companies do it. So Dropbox, as an example, now has gone to Golang, so at every stage when they've run out of performance issues, they run into performance issues based on scale, keep changing the engineering stack. And that I think is just something that the Indian product companies need to emulate, as they grow. So there's under engineering and over engineering. I see a combination of both happen in this market. But the SmaS, as I call it, services masquerading as software, very common in the Indian context. And that I think it's not by design or intent. It's just that we just don't have the product DNA very commonly available, just like we have in IT services.
I think just to add to that, because we've seen a lot of this in our past lives with respect to IT services companies, they always look towards product as a kind of quick fix to look towards, getting a lot of revenues. Unfortunately, products do require a substantial amount of investment in terms of development, performance testing, the stress testing before you can get across. And as a result of which, they start to lose patience because in a services game, they're always, always used to getting revenues or billing at the end of the month or at the end of a quarter in the case, sorry, at the end of a fortnight in the case of the US as well. And those start hurting them very quickly. A lot of other services companies have also looked towards uh, putting together or assembling a set of accelerators, as it's called, which help in terms of accelerating the development life cycles, but they can never be robust enough to be a product. So when you're evaluating a company, it's very important to understand whether they're trying to pass across some of these accelerators, as a product, and that can be very, very quickly identified based on the revenue which they are generating from their existing customers using those accelerators. Because a lot of times those accelerators never are actually capturing the revenue separately. They're all as a part and parcel of the services which are bundled and offered to the customer.
Yeah. So great points, Sameer. And I think I want to add one or two points which I've observed. So a lot of these accelerators don't have a product life cycle also, just the way products are kind of maintained. So I buy an accelerator from a SmaS or an IT services company, and suddenly I find that they're out of support. There's no extensibility. It hasn't been built. New version is going to come out, or they're not going to support whatever I have kind of bought. So that's another issue, which I see with these guys. The other thing is the way I look at acceleration or SmaS is that are they reducing the services component in a life cycle of a deployment, right? If they're not doing that, then they're just just a way to accelerate sales, nothing else.
Understood. Understood. Cool. Another question would be, so Sameer, if you can speak a little bit about vertical scaling or horizontal scaling of SaaS companies, like which one is preferred? Your views on that?
So it actually depends on what you're trying to address from the solution or the offering point of view. Because the moment you're looking towards, as Bhavish mentioned, areas like DevOps, for example, then it becomes a very much of a horizontal scalable play. It doesn't matter because it has a wide appeal across multiple verticals. But when you talk about specific areas like chatbots, for example, or you look towards what we are especially looking at from a Web 3.0 perspective, when you talk about digital twins, etc., then the preference is very deeply verticalized knowledge, because a SaaS company then needs to understand the functioning of a specific vertical to be able to really drive a lot of efficiencies for customers to really implement them. We've seen a lot of companies which are looking towards generic chatbots. They tend to die out faster simply because it doesn't really build any moats around it, as opposed to going across in a verticalized manner where on day one, when a customer adopts it, they are able to actually start gaining benefits from there. So it all depends in terms of the solution which you're looking to reach and how easy is it to develop or implement. That makes a difference from a vertical versus a horizontal perspective.
Got it. Understood. Thank you so much, Sameer, for that. So let's see if we have any other question. We have one more question. I don't know whether, the question goes as, what industries in your opinion could SaaS be a game changer that haven't been explored yet? So anyone of you can take this up.
I think very hard, but I think I want to give two examples. I don't know if somebody saw, but Intuit is no longer going to sell QuickBooks in India. That's a lot of validation for Tally in India, right? So it also shows that you can build a very sustainable business in an SME and be a market leader where nobody can virtually come and touch you, right? So that's an example of that. But I think the vertical SaaS has generally been an underappreciated kind of an area. But we're increasingly seeing very interesting applications. Sameer and I spoke to somebody who's building an ERP for laundry shops, as an example. So there are interesting companies coming out, and I think the vertical SaaS is going to be a next big areas. And India also has a reasonably good quality of AI engineers. You'll see a lot of work in the synthetic media side, whether it is speech recognition, conversational AI. So a lot of interesting companies coming out of India, and interestingly, most of those are being led by people who have a very strong academic background, because a lot of those technologies are still in the in the academic or in research labs.
And just to add to that, every time we have looked towards saying that I don't think anything further can be done, we get proven wrong in terms of the way the technology is progressing as well. And there will always be productivity improvements as well as revenue generating activities which people are going to constantly be looking at. And that is one thing which we've realized is a lot of focus in the past was purely in terms of how do I improve efficiencies within processes. So process automation, etc., became a key. But today, when you're able to marry, and this is something which Bhavish used to be very, a big proponent of when he was in Gartner, we call it as a hyper automation situations, right? Which is a combination of artificial intelligence, a combination of business process management and data analytics. And that is an area where we're going to be seeing a huge amount of opportunity coming across in terms of companies which can look at specific business processes and look towards how do we automate for a revenue generation, which helps companies in generating revenue. The second aspect is whatever SaaS product you develop, you need to encourage the concept of fail fast, both from an internal product perspective, which we're doing development to test how the market works across, but also with respect to areas which customers can help in a fail fast approach, because with the kind of proliferation of social media and the way the business channels, go-to-market channels are changing, it is very important for the business managers to look towards a quick fix and a fail fast solution. Say, if it doesn't work for me, can I move on to the next one? So any kind of SaaS platforms which help customers fail fast, try and then buy are the ones which really would make a big difference.
Understood. We are almost out of time. Just last question for the day would be, so I know Bhavish and Sameer that we have gone through this, but if you can just give us a little bit more depth into what are the key metrics to measure the success of any startup into the space.
So I think for software, I have a slide which I'm happy to show again, but definitely want to point out your last valuation is not a criteria for success. That's a criteria for good storytelling. But I think eventually, in my mind, when I look at software companies, I look at two metrics: how strongly are the customers tied to the usage of that platform? How much an arm and a leg are they willing not to let go of it? How much, that is one. And secondly, the revenue stock for themselves. If the customers love your product, they will be willing to pay for it. And yeah, I think there are no third criteria.
So I think Bhavish, you put it across very well, because customer churn, which is what you talked about, how easy or difficult it is for the customers to be retained. That is the stickiness of the customers becomes a very important matrix. The second parameter is primarily at what percentage on a sustained basis can they grow, which is what Bhavish referred to from a sales perspective, right? The moment you look at these two, that determines the ability of the company to execute their plans. The third parameter, while it is not something which will immediately reflect, it's also going to be a product roadmap strategy, right? How is it that you're looking towards a constant improvement of your product? Because even if you come up with a product and it grows fast, and going back to Bhavish's original slide where it talked about a sale use strategy, you can sell based on, you can sell ice to an Eskimo based on whatever you have got. But the question is, if you cannot marry that with a continuous product improvement of plan, both from an organic and inorganic point of view, you are going to hit a saturation level, right? And that'll reflect in terms of customer churn, that'll reflect in terms of your slowing down of growth, which will affect very, very dramatically the valuation parameters.
Wow, thank you so much, Bhavish and Sameer. It's already an hour and we have spoken so many things. Thank you so much. I'm so sure that this was really helpful for all of us that have joined us today. Thank you so much for such an insightful session. I don't think So it could have been any better. So thank you so much, audience, as well. Thank you for joining us for our third LV Insight session. We look forward for you to join us into our future sessions as well. So good evening, and we would love to see you back the next time.
Thank you so much.